Hey guys, so hello. So here I'll be giving the first lesson for our fast quant series. So I'll give some context on what fast quant is. This is actually a first episode of the series that I just gave around an hour ago, but unfortunately the video recording didn't really work. So I will just be redoing the lesson real quick so that we can spread the learnings for others who couldn't reach the session. We'll be uploading this on YouTube, and thank you so much for listening this far. Okay, so for Fast Quant Lesson 1, so first, just gonna introduce Fast Quant, like what are we even talking about? How does this connect to accessing stock data and all that kind of stuff? So first of all, fastquant is a Python package that allows you to easily access stock data from PSE Edge with as few as 2 lines of Python code. And so right now, that's the main value proposition, but really it has an overall goal of promoting data-driven investments by making quantitative analysis in finance accessible to everyone. So, like, just this initial step of making stock data from PSE Edge accessible is just, yeah, it's exactly that. It's just a first step. But, we have this really lofty goal of, making quantitative financial analysis actually accessible to, well, everyone who's willing to put in some work at the very least. We just want to make it easier for people. So, in that context, our objectives and strategies. So, the main objectives really are just number one, like we want to raise awareness and guide beginners to get a sufficient foundation by teaching the basics of quant analysis. So that's what the lectures are for. So that's why I'm doing this lecture series on how we could actually use fast quant and how we could actually backtest our own investment strategies. So we want to raise awareness of, you could actually do it. You could actually, even if you're a beginner in coding, you could actually do your own backtesting. You could do your own quantitative analysis, and at the same time, it's about like raising awareness of the value proposition of this. I think we're in a current state where investments are, well, a lot of it is being done based on like gut feel or other things, which I acknowledge is useful to a great extent. But then I hold the strong belief that if we make strategies more data driven in the context of, well, I guess in this context of trading, it's really about like ensuring that we've properly backtested strategies that we actually want to be implementing and actually putting our money in, and even more important, our clients' money in. Right. So number one is raise awareness and to guide beginners in order to make it accessible to them. So the second is we want to make quant analysis simple and easy. So now that people are aware of the tool and now that beginners are sort of guided, what we actually want to do is using this tool, we should be able to make quantitative analysis really, really simple. And so the way we want to do that is with a high-level Python API that allows for lower-level configuration for more advanced users. So the idea is that we should be able to develop an easy-to-use Python package that can facilitate data-driven investments. And so just for some context there, I could find this sort of, for people listening to this with a data science background, it's sort of analogous to, you want to do deep learning, and then, the frameworks that are available are frameworks like PyTorch and TensorFlow, and then you realize if you want to get a simple data set and, you want to, train a deep neural network on it, even if it's sort of, so like just to do it end to end actually requires, sort of a large number of lines of code, like just a lot of lines of code, right? And so for a beginner, it can come off as really intimidating, and you just get lost on the way. Which brings me to this idea of like what our approach is going to be in terms of like how we're going to be doing these lessons and how we're designing the package. So I'm very much a fan of Jeremy Howard's Fast AI. Well, yeah, I mean, I used the word fast for quant, but then really like I like the idea that there's a top-down approach to lectures and package design. So what I mean by that when I say top down is, it's sort of a contrast to how um, traditional education is doing things, where things are very bottom up. So what I mean when I say that is, like, let's say um, you learn math, right? So what you do is you do all of these like initial proofs of the basic concepts. You learn every single part, and then what you do after is you sort of combine them, and hopefully after you've spent, I don't know, 3-4 years understanding the 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 basic building blocks of the knowledge, hopefully after 4 years you can put them all together and apply them to something practical, um, like I don't know, exactly this, like applying math to trading algorithms and stuff like that. But then the top-down approach is, in contrast to that, the top-down approach is really about going straight to the usefulness. Um, so what I'm saying here is that our approach would be, we want to start with immediate usefulness and then work towards deep understanding later as more experience gained. Um, Jeremy Howard, I think, was quoting someone when he said that he would have this reference of the baseball player. When you want to have a kid get started with baseball, you don't teach him all of the nitty gritty details of baseball. You don't, all of these small things. You don't teach him about the physics of the ball and all those kinds of things. You just make them hold the bat and throw a ball at him and tell him to hit it, right? And so this idea that even if the person is just new into a field, that you want to make um, the point of the practice clear from day one, I think is a very top. It's kind of like a top-down approach, and it's something I think makes sense, and I super agree with it. Of course, it still has arguments against it, but yeah. So that's the approach that I'm choosing to take with this series. And so when we say that, like, how will that actually look in practice? So in terms of both the design of the blog posts, so I write blog posts to sort of introduce the concepts that I'll be discussing in these web lectures. So it's going to reflect in the blog posts. It's going to reflect in the lectures themselves that I conduct online. And it's also going to reflect in the design choices of the fastquant package in itself. So, like, for example, when I was thinking about, how do I want to make stock data accessible for people, I remember just this concept in my head where um, if I want to make this accessible to the regular person, let's say in finance world, like here personally in the Philippines where I come from, people are more used to using Excel, and in Excel it's understandable. And in my head, okay, that makes sense. But then if I want to make this package accessible to those kinds to people, the general public that uses Excel a lot, um, I think there are a lot of lessons to draw from how Excel itself designs its functions. Like basically everything is a function, right? And there is basically an intuitive name for the function, and it does exactly what the person thinks it's going to do. So you should expect to see those kinds of design choices in how I write my stuff. And of course, like based on collaborations with people from this class as well. So yeah, so that's the approach. Hope that makes sense to you guys. Next, just really quickly about how okay, so I'm more of working on this outside of actual work. It's more of something I do in my free time. So I think it's reasonable to expect around 1 to 2 lessons per month. But then when I say that, what I actually mean is, like, included there is a Medium article that I intend to write, and then a notebook that sort of walks us through the workflows, something like this notebook, although I put a lot of documentation in this one. And finally, the actual webinar where, just like with this one, I'm walking through the concepts of the Medium article, and going through the code at the same time in like a real-time runnable kind of way. So I think the gap that the webinar fills is that it allows me as a teacher and allows the community to really zoom into the different points of the process of learning where people drop off. Because like I intend to continue to make webinars highly interactive. So basically, if someone doesn't get something, feel free to like ask me. If something doesn't work, feel free to ask me. And then look, as a small community, and that's why I kind of like it that the community is quite small at first, is that we can do the non-scalable thing of ensuring that everyone actually um, gets to install Google Colab, gets to install the Python properly, and actually gets to do an analysis at the end of the day. So yeah, I think that's what the webinar does. It allows us to really communicate. It allows me to talk to people about, okay, where they drop off, let's fix that. With the webinar that just finished, which is exactly this lesson, um, somebody was talking about this weird error that they kept having, and apparently it was because of a misplaced parenthesis. So, those small things, you'll never know like what makes people drop off. Or sometimes it's, they can't get Google Colab to work, something as simple as that. So at this state, I'm really like encouraging people to just bring up anything that turns into a blocker. So just so that we can think harder about how we can actually drive wide adoption. Because I think that's something that's often left out with software today. It's like people build things, it's supposed to be scalable, but because it's scalable, sometimes it's not as easy to use for a regular person. And sometimes, well, often scalability like um, precedes the ease of use for a beginner. Like, and I like to draw a distinction between ease of use for a beginner and just ease of use for a seasoned developer in general. I think um, a significant gap is left from the lack of usability for people who are just quite new. And when I say you're quite new, like I'm literally saying like 1 week into Python to like maybe even 1 year, right? So I think that's interesting, and that's what I want to focus on in terms of just because I think that's a scalable way to be creating impact with this. So okay, there. So if we can turn the Excel users into Python users for finance, that would be a great like tangible thing um, to really want to do. Okay, so sort of went sideways there. Yeah, so 1 to 2 lessons per month, we can expect that. And at the same time, I want to create the expectation that webinars will be recorded and posted as content on Facebook/YouTube. I think right now I'm thinking about YouTube. So you're probably listening to this from YouTube. So thank you so much for listening this long. And do expect more content through as we do this course more. I am hoping that I can record the actual lectures with actual interactions with students and like collaborations, just so that we, like as a listener, you can actually get their listen to their feedback and actually like learn from it as well. I think that's huge value add from just having people like ask questions real time. You understand the holes that you're leaving from your presentation. Okay, so moving on, just really quickly around the course outline. So the mental model in my head right now is that there is a part 1 and a part 2 for fast quant. So the first part is really, so the theme thinking about is more of backtesting classical technical analysis indicators. So the goal is, number 1, familiarity of people with technical analysis indicators, just the classic ones. So for the finance people, that's your classic like RSIs, Bollinger Bands, like your moving average, convergence, divergence strategies, those kinds of things. So if you can get, so by the end of the first part of the series, ideally people would know conceptually what those indicators are. They would know their pros and cons, supposedly. They would be able to know as well how to derive them straight from, well, Python. Like hopefully we'll have like high level APIs to make that easier by then. But yeah, so ideally people should know how to derive those indicators from Python straight by the end of part 1. And at the same time, after deriving them, the goal is to give people the ability to backtest those classic technical analysis indicators by the end of part 1. That's why that's the reason for the design of this lecture series, part 1, where you'll see lecture 1 is like the one right now is where it's more of accessing PSC data in 3 lines of code. I think I said 2 lines in the different, so I think that's a small error, but yeah. So lecture 1 is like, okay, how do you just get a data? Because it all starts with the data. So lecture number 2, I'm just gonna show like it's gonna be really the introduction to backtesting and how to do it in the simplest way possible. So the goal here is that by the time people get started with a lecture, like a Medium post and a notebook would have been posted something like a week before. So if you're like a really dedicated person in terms of like learning this content, like ideally you would have been able to read the notes right before the webinar, so that we can actually have like some sort of some useful conversations around, oh, what should we be doing next, or what feedback do you have, or what did we miss out on, or maybe something you find some sort of bug and you want to report it. I think that's super interesting. And so yeah, so I'm going to be introducing backtesting in lecture 2. And then after that, probably, yeah, with 5 lines of code. So how is that going to be possible? So just for some context with the 5 lines of code, so I do like this idea that, the more lines there are, like, it is like complex for beginners. Like, there will be arguments around, oh, less lines doesn't necessarily mean better. But in the context of a beginner, it actually is sort of, of course, I'm assuming each line is sort of like one function call. But yeah, that's why, like, that's one measure that I'm thinking about that makes sense in terms of making it usable for beginners. And so how are we going to do that 5 lines of code? Because in the current way that people do backtesting, there are backtesting frameworks. But the thing is that, and this is sort of connects to the value proposition of this framework that I'm talking about, is that for people to do like intense quantitative analysis with finance, they kind of need 2 things. Like, one is they need some finance domain knowledge. It's like you sort of need to know finance, like, well, at the very least, like, just some foundational level of the finance, right? Just so you know that you're doing things right. But the second is that you need to know coding. You need to know a lot of coding, and I think coding tends to be like the larger barrier, simply because, if you want to actually do these simulation backtests, like, you can see from the frameworks that are currently available. So for one example is that I actually personally like is the Baptizer framework. So you see it over here. And it's honestly still pretty low level. Like, this is supposed to be like a hello world. And if you talk to an absolute beginner, like, this doesn't look like a hello world at all. Like, there's so much stuff moving. So what I intend to do in the context of backtesting, like, how can I turn this into 5 lines of code, is like, probably if I can turn this into, I can create a higher level, I can turn fast quant into a high level API on top of like a framework like Backtesting, and then have a sort of library of strategies that are already abstracted away, so that beginners can actually run backtests in 5 lines of code instead of, well, here, just a bit more, right? So yeah, should be interesting. And glad to get feedback as well in that. So this is on YouTube. Please just ask questions or have suggestions in the comment section below. So there, and after that, so lectures 3 to 5 will be really focusing on I'll just be following this pattern of introducing a technical indicator, because remember, we just want to introduce technical analysis. I'll be introducing a technical indicator, and then we're going to be I'm going to make sure to teach people how to apply backtesting to that, assuming that indicator is being used, and then apply that to the RSI, Bollinger Bands, moving average, convergence divergence. So you can see intro plus backtesting. And of course, like, I wouldn't even say this set in stone. I'm super willing to hear feedback on like which indicators you would prefer. But ideally, anyway, the goal is that after this, you could actually get whatever indicator you want and then actually run a backtest on it. So that's the real goal. Like, teach you how to fish instead of, I'm not gonna keep making tutorials for each of the indicators, right? So hopefully by the end of it, we will simultaneously be teaching you guys like how to do that with your own indicator of choice. And most of them are going to be like easily importable anyway by this time, assuming that we have the high level APIs down pat. And then finally, for the end of part 1, we have lecture number 6, where just going to be talking about, okay, so till this time, we will have been like backtesting single strategies one at a time. So what if we want to combine them? And that is actually an approach that's pretty regularly used a lot by people in practice. So yeah, something simple like that, just combining things. So that's the end of part 1. So after that, backtesting classical technical analysis indicators. And so here, just a really like note, this is like to be discussed, definitely just to be discussed a lot, is thinking about a part 2. And right now, the way I'm thinking about it is, and actually initially it was just the first part without the plus. I was like, oh, like maybe we could be building advanced indicators with statistics and machine learning based approaches plus other financial indicators. So I initially didn't have other financial indicators. I just said statistics and machine learning based approaches. And then someone brought it up to me like, oh, hey, like maybe we, even before like applying these advanced or I mean, I just call them advanced because they use ML and stats, right? Like more advanced models. But um, what might be more useful is if we learn how to include financial indicators aside from just regular like pricing and stuff like that. So yeah, I mean definitely. So I just included that here as well. Like, so I think a better theme for part two really is like how let's teach people to have the ability to create their own custom indicators, even outside of the universe of classical technical analysis indicators. Like, for example, like what if you wanna, what if you have a forecasting model for the price of Jollibee JFC, right? And you want to turn that into a technical indicator. So how do you actually do that? Because a lot of tutorials and a lot of people in like these blog posts, what they do is they try to forecast the price and they show, and often in a misleading way, how accurate or quote unquote inaccurate the model is. But then, like in the context of trading, what really matters is like how do you turn that into an indicator? Like how do you impute that into the system that eventually turns out buy and sell signals, and how will that trading strategy perform over time? So like yeah, so whether I think so that's where I think it makes sense to think of part two as really just how do we make our own financial indicators and how can we like backtest them from scratch. So we can, whether it's using stats, whether it's using ML, whether it's using like other financial indicators and applying ML to those. It could be with like sentiment analysis based indicators. It could be with forecasting based indicators. It could be with expectations variables, like I don't know, like let's say it's like 2 days after an earnings announcement that was actually way above consensus. So running models around those I think would be interesting. So yeah, so that's just a sneak peek in part two. We're not going to be talking about that for a while. Given the timelines we just said, I think part one would take around like maybe 3 to 6 months, right? So yeah, it'll be a while. So finally, just quickly talking about the setup. This is me walking people through. Oh, let's just make sure. I just wanted to make sure that people knew how to use Google Colab. So I'm using Google Colab for two reasons. Like one, just so it's clear to everyone, right? So one reason I'm using Google Colab is that it's just really easy to use. It's easy to use. It's shared. I can set privacy easily. I can share it with whoever I want. It's also free, right? So yeah, it's accessible for those reasons. The second is that because the Google Colab like instances are pretty much like standardized in terms of the packages and all those kinds of things, you can be pretty sure that if something works on your like Google Colab instance, it'll probably work on like another person's Google Colab instance, assuming that they did the exact same thing that you did. So I think that's really convenient in the context of like just teaching things to people, because you don't have to worry about whether like the problem, like the classic Docker value proposition, right? Of like it works on my machine but not their machine. So this sort of solves that, and we don't even have to use stuff like Docker or all that kind of stuff. So I think that's pretty good. It's great that we don't have to care about that. And just second thing, in case you don't have a GitHub yet, I super recommend that you make an account. And if you do, please do look through the backend code of fastquant. Super keen to get feedback. I got some people like offering to contribute into the context of and not just in terms of like trading strategies, but even just refactoring and stuff like that. So that kind of those offers, I super appreciate them. Yeah, need all the help we can get. I mean, as I said, I just work on this in my free time, but so any help is super way appreciated. And lastly, of course, like if you use the repo, you're a fan of it, you think it's useful, or I don't know if it's useful enough in the context of like you actually like getting value from it. So please do put a star in it. Like if you find it useful, let's let other people know that like it's something that they could actually use for their work. Whether it's for fun, of course, or whether it's your job, because everyone's supposed to care about investments. Like I do strongly believe that. Eventually, not just with the equities. Eventually, when we start adding like other types of information, like real estate prices, and like we could even widen the scope of this thing to beyond the stock market, like whether it's the bond market, whether it's thinking about where should you buy your next house, like geospatial kinds of decisions, I think would be interesting. So yeah, that's pretty much it for the non-coding part. Let's just jump straight into the coding. So the first step, the way I'm gonna actually do it is for most of like the blocks of code, I just have notes for each of them. So the goal when I made this notebook is that you can actually read it without thinking too hard. Like you can read it and then run a block of code and read it and run a block of code. And so hopefully the writing in itself is already good enough. I got a lot of feedback earlier and like where some of the confusion still lies. So yeah, she should be fine. So okay, so the first step is actually and this is found in my blog post as well recently on accessing Philippine stock data with only 2 lines of code. But yeah, so the first part is we actually install fastquant. And it's just super easy because it's registered in PyPy. So what that means is that installation is as simple as a pip install. Yeah, so you see it's super quick. It's also quick because I already installed it from earlier, but it should be the same with yours. Assuming that you have it in Google Colab as well. So second section is, this is the part, the really crucial part where we get people to get stock data from PSE in just 2 lines of code. So here I demonstrate how to get the stock data of Jollibee. And although I represent it as JFC, since JFC is the stock symbol of Jollibee, from January 1, 2018 to January 1, 2019. So you'll see, so all we have to do is we import this function called getPSEData from the fastquant module. So if you install it, this should work. And then we just run the function getPSEData. And then the first input is the stock symbol of the company, JFC. And then we have the starting date and then the end date. So take note that the date formats are in this like YYYYMMDD, which just means that it's year, month, day in numbers. So and it's separated by dashes. So you make sure that that's the case. And so if you run it, there. So it should be actually pretty much that fast. And you'll see here that so what I'm doing here is I get the PSE data, it's saving to the df variable, and since it's a pandas data frame, it actually returns a pandas data frame. And if you don't know what that is, don't feel too bad. I actually have some recommended readings as well at the end of this tutorial on how can you get up to speed with some of the basic Python stuff. But don't worry, my goal actually in designing these APIs is that you should be able to use it with really basic knowledge, just pandas data frames and matplotlib in general, on top of just the fastquant stuff should be fine. So here we do a df.head. So what that does is it shows the top 5 rows, and you'll see essentially like 6 columns. First one is the index. It's a date time. It's DT for date time, but actually it's more of a date. So just say that stands for date. And you'll see that it's in the format that we specified, right? So 2018 1 03, so that's January 3. You'll see that the first one is January 3, so it probably was in stock data back in Jan 1. And you'll see that on top of the dates, you have open, so this is the price at which the stock of Jollibee opened that day, the highest price that day, the lowest price that day, and then the closing. Finally, the value. So I think this is the total value traded for that day, if I'm not mistaken. There was some conversation earlier as to whether it was like value or volume. The fact that everything was rounded off to a whole number made me think, okay, maybe it is volume, but yeah, I got some feedback that we might want to integrate the physics. There's like a PHISIX framework now where you can get volume specifically, so we might want to integrate that into this. But yeah, that's it to do. So yeah, so pretty much this is your stock data, and typically you focus on closing price because it's more of an indication of like the price at a specific time point. So in this case, the closing price is the price at the end of the day, end of the trading day, specified. So here is Jan 3, so it closed at 255.4 pesos, and this is in pesos. Okay, so that's not clear. And on Jan 9, 2018, it closed at 255.8. yeah, so here I'm just applying help to it, show you guys how. Okay, start date, end date, and other stuff doesn't really matter for now. So there, now that we have the data, super easy, got the data. And remember that thing where I said, it's just like an Excel function. So that's really the goal, because I want Excel people to start using this more. So now that we have the stock data specifically, the next step typically is, when we have time series data over time, we want to plot it over time just to see how it looks in terms of, is it going up? For example, that's a basic thing to ask. Is it going up? Is it going down? Is it sort of flat overall? Is it flat but it went up and down in different times of the year? Stuff like that. So those are the questions we want to answer. And so for this part, we'll want to introduce just a simple plotting package called PlotLib. So if this is not so clear to you, feel free to read the beginner learning material. I'll be linking in the end of the tutorial, but for now, just take this as is and realize that, okay, the important thing is that we got the pyplot method from matplotlib, method, but a module in itself. What we're doing is df.close. So this means that from the data frame, we're getting the closing prices. And then what we're doing is we're plotting it with this size, with this fig size. And then with that, we also have the title, and then a font size for the title. So now you can just run this since you have the whole thing. And if you run it, you see it's doing the plotting quite well. So as we said, okay, so is it going up over down or going down over time? So it's right now it's like, if you think about it, it's like sort of flat, like on average. Like it's going up, down, but then really the peak is pretty much the same from March 2018 to like December. So if you draw a line here, it's probably like something like flat or maybe a bit upward. Although that's not the whole story, right? Because sometimes it went up, it peaked on March 2018 by actually quite a lot. And then it went down, especially sharply from around mid-June 2018 to the beginning of July. So that's pretty interesting. And then it peaks again in like September, and then goes down again beginning of October until it peaks again to like, I think, almost the same as the previous high for the same year on beginning of December. So yeah, I mean that's an initial look, an initial analysis of the prices of Jollibee. Yeah, okay, so it should be that's really how you start. And so the next is, okay, now that we have these prices, like what we actually care about, right, is we want to turn we want to look at a trend and know when to buy and when to sell. And so the idea, right, is, well, you want to buy when it's cheap, you want to sell when it's high, right? So how do we know when it's time to buy, meaning it's cheap, and when to sell, meaning it's at its peak? And so that's where the indicators come in. So when we say technical indicators, or just basically indicators, what we're referring to are these sort of metrics, these derived metrics from which these are derived metrics from which you can output trading, like trades, actual trades. So for example, like if you have this strategy where, okay, my strategy is, my indicator is just the constant number 260. And so my idea is that, if it goes below 260, I think that should be a sell. So the 260 line in that case is an indicator, and the crossover of the price itself, the closing price, to below 260, and that indicates a sell, that is a strategy in itself. So it's when you create logic from the indicators of choice and turn that into an actual buy or sell action, or even hold. So how do we do this? So what we're going to do is we're going to start with one of the most basic, but I would say powerful, classic technical indicators. It's called simple moving average, and the strategy is to do a simple moving average crossover. And how we do that is we must first import what is called the pandas library. So it's a general purpose library for handling tabular data. So just the regular import pandas is PD. So just run this in case it's still not running. And then next, we calculate the 30-day moving average of Jollibee's closing price, and we combine it with the original closing price data. So remember, the closing price data is the df.close. So we plotted this earlier, right? So what we want to do is we want to get the 30-day moving average. So in the slim chance that you're not familiar with moving average, so what that basically means is for each of the days, what you do is for each day, you look at the price for the last 30 days, and then you get the average. Now that average is the 30-day moving average for that day. And then you apply it for all days moving forward. And so after that, so you have this trend that you can then combine with the original closing prices, and you can plot them together. Right? So what we're doing here is we're deriving the 30-day moving average. Okay? So what we're doing is sort of similar to earlier. So we start with the data frame. We get dot close, so that is the closing price of the stock. We apply the dot rolling method. So what this essentially does is it specifies the period that we use for the aggregation. So in our case, our aggregation is mean. So we're getting the average. But for how long, so for how far back. So since we want to go back 30 days, we indicate 30, right? So we do a dot mean. So the MA30 here should return to us the 30-day moving averages. And so after that, we concatenate it. So concat means we just combine. So we combine the moving average, 30-day moving average, with the closing prices, and then we drop the NAs. So there's some numbers here I won't explain now. But then if you have any questions, feel free to just ask. So close MA30.column is equal to closing price. So what we're doing in the last line here is we're just renaming it so that closing price is named just simply closing price, and the SMA is just really simple moving average, just so it's clear once we plot it. Then finally, this is just me like showing how that looks. So just like earlier, you'll see that, okay, there was a data frame over here, but then what we're seeing are the closing prices, 255.4. But then when you get the MA30, it's actually returning like these huge decimals. And that's actually expected behavior, right? Because what we're doing is we're getting averages. And so one of the effects is, how does that make the trend look? So why don't we plot that? And so that's what I do here. So let me just make sure it's running. And so we plot it, and you see this is how it looks, right? So how does it compare to the original closing price? You'll notice that, well, it's smoother, right? I mean, that should be that's one of the most obvious differences. So here, the shapes look similar, right, overall, but then this is smoother. So it's actually one way to what you call like smooth data. You'll see here that what we mean by smooth is that this one goes like, it's pretty erratic in the sense that it goes up and down a lot, goes down and goes up and down a lot. But here it's just a lot smoother. And that's what these aggregations do. And then now let's plot them together, right? So we plot them together. So close MA.plot. So remember, close MA30 is the combined, it's the combined data frame. So we combine closing price and simple moving average. And so when we plot that, it should show both of them together. And so the comparison earlier should be especially apparent now. You'll notice that an orange is a simple moving average, and blue is the closing price. And you'll notice that the closing price, again, it's erratic. And then the simple moving average is actually much smoother. But what do you actually do with this information? So remember, these are the indicators that we're using now. So what makes it a strategy? So it's called the simple moving average crossover strategy. It's a very basic strategy. What you do is you treat, it's this strategy wherein you have a simple moving average and you have the closing prices, which we have now plotted, right? And you treat the crossover of the closing price as a trigger for either buying or selling the stock, depending on whether the crossover came from below or the crossover came from above. So the idea is that, so if the closing price crosses the simple moving average from below, that is what they would call a bullish indicator. So what it would mean is that, hey, there's momentum that the price is likely to keep going up. And so what that means is, hey, if it crosses over from below, hey, let's buy that stock because we think it's going to keep going up. Okay, and so when the opposite happens and the closing price crosses over from above to go below the simple moving average, that's now the opposite. That's more of a bearish signal, wherein it's an indication that the stock is going to keep going down. So let's look at a sample, right? So here it's sort of like, it's sort of moving up and down, but it's not super clear. It's still sort of near. But then, okay, let's start from the crossover starting from July 2018. So you'll notice that the start of July 2018, closing price was around like 245. So it's significantly below the simple moving average at this point. But then, leading towards August 2018, it suddenly crosses over from below the simple moving average to above it. And so, as we said earlier, if the if the closing price crosses from below to above, that is a bullish indicator from an SMAC standpoint, and so it's an indication that you should buy it. So it's a buy signal. So okay, let's say you bought it, right? Let's say you bought it before August, and so okay, it crosses over, and it moves above, and what actually ended up happening is it peaks at around below September, so like mid-August, although it goes back down, right? So if assuming that you sold it, you knew that you wanted to sell it around before September, which sort of makes sense because it was moving closer to the 30 days simple moving average, you actually would have made money, right? So if you bought it here, it was trading at 255, and then if you sell it at 275, you would have made like 20 pesos per share that you have, right? So from that sense, like if that was your trading strategy, then okay, visually you could confirm, okay, you would have made money in that trade. And so you could do the other way around as well. So so since it crossed over to below, what if like you were holding a stock and then finally there you take profit at that point and you sell it, and it actually does go down till the beginning of October. So in the context of, so the conclusion here is that if we apply this 30-day SMA strategy from July to October, we actually would have made more money compared to had we just held it. Because, right, if we bought it before August here and then we held it till beginning of October, we would pretty much be the same price. But then if we bought it here and then we sold it at the point at which we should have sold because it already crossed over here, we would have earned something like, so it's coming from 250 up to around 275, so 25 pesos per share. But you get the idea, right? Definitely didn't get those numbers exactly. But yeah, so that's the thought behind it. But then, of course, what you'll notice is that, this is a visual way of confirming it. So ideally, and this is where backtesting comes in, and I just want to introduce you guys to the concept of, like, the idea of backtesting is that you can have these strategies. So let's say it's a 30-day simple moving average crossover strategy, and what you can do is you can sort of travel through time and simulate how much the strategy would have earned, assuming that you use that strategy. And so what you can do is you can actually compare different trading. You can perform the backtest. You can calculate how much you would have earned, or even like your earnings distribution. And what you can do is you can compare your earnings from the 30-day, assuming you have done it, compared to a 20-day, compared to a 40-day SMA, or even a completely different trading strategy. And at least from there, in the context of historical performance, you would then be able to say, hey, I think this strategy is better because over time it actually did do better. And of course, assuming that you took, like you were pretty rigorous in your analysis. And later we'll discuss like how should you be rigorous when you're doing backtesting. So yeah, that's pretty much it. But this is a good intro to it. So this is the context. Like this is, you could call it like a visual backtest, but then later we would want to be more quantitative with this so that we can be more objective, right? Because it's really easy to, like, that's why some people make fun of TA when it comes to just like looking at it, because it kind of feels like you're reading hands sometimes. That someone else said it. Okay, it's not, I didn't coin that. Yeah, exciting stuff. And yeah, before I get to the final, just me sharing some relevant resources, just one bonus section over here. We actually reached this earlier as well. So I just wanted to share about how, till now we only had information about the price of stocks. But then when I talked to a lot of people in equity research, and I actually did an internship in equity research, and I do read into stocks a lot, and a lot of the talk is really about news. It's about disclosures, like stuff on paper. It's stuff on documents and stuff like that. And so it's not hard to imagine that if we are able to capture information on disclosures, we should be able to make money out of that information. So it could even be like, let's say it's an earnings announcement, maybe it's a merger, stuff like that. So just introducing like this latest, and it's really in beta phase, I would say, like function from fastquant. So it's just get company disclosures. That's what it's called. So what you can do is you just have to input a company in a date range. I think there was a default date range here for JFC. Let me just like test that out real quick, just to make sure. Oh. Yeah, there's a default date range here. So let's put that in. Yeah, so okay, so this is really long. Let's make it a bit shorter. Let's make it 2018. So let's say we want to get the company disclosures for Jollibee. Remember, that's the stock symbol, Jollibee JFC. We want to get it from 2018 June 26 to 2019 June 26, right? And so it's saved in the JFC disclosures variable. And what we could actually do is, okay, so we saved it already over here. What we can actually do is, okay, get the first row of that just to show you guys like how it looks. So you'll see that it's pretty interesting because we have the name, company, okay, Jollibee Food Corp, but you actually have the name of the disclosure. Like, okay, let's do a sample of this just so I'm curious as well. Yeah, so here's notice of annual or special stockholders meeting. So, all the information in the special stockholders meeting. And the cool thing is that, I've worked on the code enough so that it actually returns like the URL to the actual document. So let's say you click this, it's actually going to return to you the document from PSE Edge. So, we could actually get this information and do some really interesting stuff with it, with all this text. This interests me, especially coming from a data science background, and I do a lot of work in NLP, natural language processing. So you could actually do a lot of stuff with these notes and amendments, even the agenda, right? Like, are there words in the agenda that are associated with upward movements? And then we can turn those into indicators. But then that's a few steps forward. I'm also playing this for anyone who wants to contribute to like processing this information, because it should be like really valuable. In the context of making actual indicators. So yeah, should be super cool. Yeah, we could just play around with this a bit. So what other disclosures are found here? So everything's pretty much. So here's a press release, right? Notice of annual or special stockholders meeting. Okay. Okay, material information transaction. So yeah, it's all like really interesting stuff. Like, imagine amendment to the bylaws. Like, what was that amendment? Like, when does an amendment translate to a sudden surge or a drop in price? I mean, those are interesting. I mean, I think even from an academic standpoint, like getting this kind of information is really interesting. So very keen to get, as you would know as well, though, like if you have, because this is basically getting internet information and parsing it. So that means that if we want to effectively use each of these kinds of templates, we might need like separate. We might need to create separate logic for each of the templates. So that's where I would need help with in the context of this. But imagine the possibilities, right? You can get these disclosures. If you get the text in the proper format, you can apply like sentiment analysis to it. You can apply information extraction. So there's a lot of like things that you could be doing with this. So yeah, just put a random question here, like how can we apply a sentiment analysis to company disclosures? Right. So like yeah, just to pique interest for people who are also dabbling in just natural language processing as well. So yeah, that's pretty much it. That's pretty much all of these stuff. I hope that was understandable. Just really finishing this off with some relevant resources that I recommend. Like one is the actual blog post. This is based on you might have wished, oh, why isn't it just like a straight to the point tutorial where I show you how to get the 2 lines of code and that's finished. Well, if you want that super quick tutorial, just look at the blog post. It just goes straight to the point, goes straight to the code. But here I'm really talking about like the lesson in the context of the rest of the course, the rest of the series that I'm going to do. So as you can see from the initial plan, so we plan to have 5 more lectures before the end of part 1, but should be really interesting. So next is, well, some people have coding background, but they don't have finance background. And although, like I said, that you need finance to make expertise, I would argue that it's not, I wouldn't say there's like a whole lot that you need. Because at the end of the day, like, especially in the context of technical analyses, they're just formulas that define indicators. So as long as you have a high level idea of like what do the indicators mean and how do you derive them and what are their pros and cons, when should you use them, and then as long as you know how to like apply that to Python and backtest them, that should be pretty much enough because I really believe in the concept of rapid experimentation. So it's easy to hypothesize that an indicator sucks, but you don't really know until you backtest it, right? Otherwise, like, what's your argument against it? So yeah, so if you know about like coding, but you still don't know you don't know about the indicators in technical analysis, like well, some people I don't know would super approve this, but yeah. So Investopedia is like a good like beginners intro to a lot of these concepts, and I want to make it also like really easy for you to get in. Like I don't want to bore you with really long textbooks that go bottom up. So this recommendation of just quick summaries from Investopedia, it's also a top down like approach to recommending content. I mean, then we can just talk about it in more detail later. And finally, like if you are in the domain, or even if not necessarily in the domain, like on top of the Investopedia material, like you could get into this learning plan that I actually wrote out a while back. I mean, there are a bunch of learning plans. A lot of people have learning plans, but if you're asking me what I recommend, this is the learning plan that worked for me. Feel free to look for other people's learning plans, but yeah, I do recommend like going from this, and I do give a list of resources that you could go from like the beginning till the end, both in terms of like conceptual learning, which is more of like books, until like practical learning, where it's more of like here I talk about like how I dabbled in competitive coding, well, for data science like Kaggle, passion projects, all that kind of stuff. So yeah, so I recommend these. There are definitely more, but those are just a few. Feel free to like message me. Um, if I post this on YouTube, I'll have my my public contact details there in case you want to ask any additional questions. So yeah, with that said, thank you so much for taking the time to listen to this, and I hope to see some of you guys in the next fast quant sessions. And thank you so much.